Yes, by the way, in between, shows Havells numbers had come. They looked quite good. The only reason the stock's not rallying is because of positioning. Again, the market gets positioned so much in favor of the numbers. And if you pull out a slightly longer chart of Havells, it's a stock which has had a rally from I think 650 up until 730 thereabout in anticipation of these numbers, as you can see on the screen. But the numbers are good. The margin performance is really good.
Maybe you want to put even a longer chart of Havells, maybe 6 months, 1 year as well. Yeah. It's one of those few consumer durable guys not terribly dependent on China.
Yes, and
that's another reason that went for them.
Yeah, it's been a consistent performer as well. Of course, always been an expensive stock, but let's see. I mean, as I said, because of the positioning, the market is reacting the way it is. Let's see what happens from here on. Pramod Gubbi is joining us, co-founder of Marcellus Investment Managers. Pramod, good afternoon. So, the market showing some signs of fatigue, and this whole second wave in the Europe and what's happening in the market, in the US market. I don't know if you follow the market technicals, but the fact that the market slipped right from the levels from where it slipped in March, does that give you uncomforting signs, or do you think this is a dip which should be bought?
Well, I mean, we're very far from that line of thinking, given that the only thing that we tend to focus on is fundamentals. So neither the US elections nor anything else that we see on the anvil are actually affecting fundamentals adversely. Of course, we are watching the surge in COVID cases globally, and of course, it could potentially happen in India. Luckily, we've seen a pretty good last 4 weeks in terms of consistent decrease in active cases, but we are open to the possibility that we could see a surge here as well, in which case there are ramifications on the fundamentals of the economy through a second wave of lockdowns and so on. However, certain other factors that perhaps concern majority of the market participants do not concern us. We have no idea about the US elections nor the consequences of those US elections in terms of policy making. Certainly impact on the fundamentals of our stocks. As far as we are concerned, we're watching the recovery in the economy. We're seeing most high-frequency indicators suggesting a more sustained recovery. And hopefully, without a second wave of coronavirus, we should be able to see this sustained well into FY22, in which case most of the fundamental macroeconomic parameters should normalize. And indeed, we are taking a little more of a positive stance in terms of expectation of the economy over the next 2 to 3 years, given that we are looking at a sort of a convergence of various stimulus, whether it's monetary or fiscal, aided with a couple of reforms as well. And we're also seeing a fairly stable exchange rate regime alongside pretty low oil prices. And a lot of these are pretty necessary conditions for a recovery in the Indian economy. So we're looking at the situation in a more sanguine manner.
Okay. Good afternoon, Pramod. Thanks a lot. Sanguine about which part? I mean, clearly financials are likely to be hurt even more if we lock down a little more. But so would consumer durables, isn't it? Wouldn't you have a set of consumer durable stocks in your portfolio? This second wave in Europe, not in India, but Europe, could mean bad news for any of your stocks? Export-oriented ones?
Yeah, I mean, I wouldn't disagree, because second wave is the one that we're watching out for. But for now, we are seeing the numbers fairly consistently trending down, at least in India. But yeah, the second wave would hurt pretty much all sectors, other than the fact that there are some essentials or staples in our portfolio. But however, we're looking at a situation. None of us are virologists to be able to predict a second wave. We're watching the situation. We're speaking to experts. But barring a second wave, I think most parts of the economy will tend to benefit, given the confluence of factors that I talked about, whether it's monetary, fiscal, exchange rate. We're perhaps the only country in the world which is seeing a fairly sustained inflation, albeit inflation could be supply-driven. But I think a recovery in demand is underway, and barring, like you said, the second wave or any other thing which is unforeseen, we can see this demand sustaining into the future, which should augur well for many parts of the economy.
To add now, I mean, I'm sure you're getting dollops of PMS and other capital on a daily basis. What is the incremental split? Is it to go more towards IT and pharma, which are somewhat resilient? I mean, pharma definitely. Or is it to go more towards unlock and therefore people will consume more of something or the other?
Right. I mean, we generally don't look at it that way. We more bottom up. We look for resilient businesses to start with, irrespective of which sector they are in. Resilience, not just to the economy, but resilience to any sort of disruptions, whether technology disruptions, competitive threats, regulatory changes, changes in consumer preferences. All of this are constant. The world is a changing place, and we need to invest in businesses where management teams are alive and awake to these changes, and they preempt these changes by taking necessary action in time. We will never be experts across all our industries to be able to foresee these changes. The only thing that we focus our energies on, what is the management who's supposed to be the expert in that industry doing? Are they still focused and passionate about the business? To that extent, there is a resilience built into the businesses that we invest in. However, having said that, if you ask me to look at particular sectors, I think we're still more keen on financials. Financials is perhaps the only sector which still hasn't recovered completely in this rally post-April. To that extent, we are seeing some of the higher quality financials also still available at relatively attractive valuations, when we think that this sort of a crisis situation actually benefits those sort of banks and NBFCs in particular, who have the capital to ride out this crisis, who started off the crisis with a better asset quality book, and therefore will come out of the crisis with a larger market share. And at some stage, the crisis should end, and when the crisis ends, you will see a recovery in the economy, and the recovery in the economy will be accompanied by recovery in credit demand. Okay. And if at that stage you're invested in businesses or banks and NBFCs...
Can you name them? Can you name some? Because it's such a mixed bag. What do you have in your portfolio?
No, I mean, we have all the usual suspects. We haven't changed anything. We have HDFC Bank, we have Kotak Mahindra Bank, we have Bajaj Finance. Amongst the non-lending financial services, we own HDFC Life. So, I mean, nothing's changed in our portfolio. Like I said, our investment philosophy forces us to invest in businesses which actually thrive from crisis situations like these, and therefore come out of the crisis with a larger market share. And this is one sector, mind you, which is still relatively fragmented in a country where most other sectors are either monopolies or duopolies. And therefore, you'll also have the tailwind alongside a recovery in credit demand. Some of these businesses will come out with higher market shares, and therefore they'll give you disproportionate growth at the end of the crisis. The first 2-3 years post-crisis have always been the best time to stay invested in these companies.
Okay, Pramod, I was reading a Marcellus blog about the next set of nifty stocks that you anticipate, and two names which stood out for me in that list were Pidilite and InfoEdge. But with the kind of rally that we have seen in these two stocks, what would be your view? Do you hold any of these two stocks in your portfolio?
Yes, we do hold Pidilite and InfoEdge, both of them in some of our portfolios. Pidilite across most of our portfolios, InfoEdge across some of our portfolios. Yeah, I mean, we were not perturbed so much about the rally because we believe that the rally is commensurate with the improvement in fundamentals, particularly with Pidilite, with the acquisition that they've announced today. We think that the market opportunity, the opportunity to derive synergies out of these acquisitions, open up the future prospects immensely. And this is pretty much in line with what we try to identify. We try to identify monopolies. Pidilite has been a monopoly in some aspects of adhesives. Araldite is yet another monopoly in epoxy adhesives. So this is pretty much in line with what we would look for in businesses. The resilience, not just to economic cycles, but also resilience to competitive threats, which is often tends to get overlooked by investors who simply get carried away by growth prospects without acknowledging the potential competitive disadvantages which can destroy value. To that extent, both Pidilite and InfoEdge are literally not just market leaders, but market leaders by a margin in the areas they operate in, and therefore, we believe they'll continue to create value, particularly if you have a view that India will continue to grow at 5-6% real GDP for the next 10, 20, 30 years.
A very quick question on alkyl amines. Are you still holding it in your portfolio? And again, do you see it as a consistent compounder?
Well, we hold it in our Little Champs portfolio. I think it's on its way to becoming a consistent compounder. It has all the ingredients in place. Again, it is a market leader with a distant second, with a significant monopoly, or perhaps if you want to give more like a duopoly with Balaji Amines being the second player. But I think Alkyl Amines has significant competitive advantages on the chemistry front. And this is clearly acknowledged by a number of its customers who we've spoken to, who have immense confidence in Alkyl's ability to support their growth for the future. So yes, we continue to hold it. We're happy holders. We reckon it's a little champ as of now, but it's on its way to becoming a consistent compounder.
Right, Pramod, we will leave it there today. Thanks a lot for joining us. It was good talking to you. Before we take a break, just look at Cholamandalam.
I know, it was about 2% up, I think.
Yes, look at the intraday move on the stock. And as coincidence would have it, it was, I think, 2 quarters back that we had the similar move on Chola. It came at closing bell time. And that day also me and Lata were anchoring
Oh, really?
Chola, closing bell. But yeah, I mean, just look at that move on Cholamandalam. It's a decent move that you're seeing on that stock, especially in the context where in most cases good results are getting sold into. Like you've seen with many cases, Ultratech, ACC, today Havells, previously Colgate, so many good results getting sold into, at least on that day and next day. But one thing about good results is that, after the pre-positioning is adjusted, good results will always be rewarded by the market. Sooner or later, the market will do that.
Actually, we should pull up a 6-month or a 1 year of Chola as well. I mean, there's no denying that after that March-April fall, it's been consistently higher highs and higher lows.
Yeah.
See, that's the kind of chart. So anyway, we'll put that to our chartists. We have to take a break, as Anuj said. We'll come back. We'll get insights into dealing rooms. What are they chatting in this whipsawing day? We will also get to the key earnings that are expected tomorrow. Big Boy Reliance is one of them, as also IndusInd, UPL, other nifty